By the end of this video, you will have a one-page trading plan you can run on your very next trade. Let us build it step by step. Before we meet anyone, let us get one thing crystal clear: what actually is a trading plan? Because most people think it is a feeling or a hot tip. It is not. A trading plan is 5 simple written rules, and for the rest of this video, you are going to watch what happens to 3 traders depending on how many of these 5 they actually follow. Number 1, your setup. A plan starts by naming the single, specific pattern you are hunting and ignoring absolutely everything else. Here it is: a pullback to support inside an uptrend. When the chart matches that picture, you hunt. When it does not, you sit on your hands. No setup, no trade. Number 2, the checklist. Before you are allowed to click buy, every box must turn green. Is the trend in my favor? Is price at my level? And the big one, is my reward at least double my risk? Look at the chart. The green reward zone is twice the red risk zone. That is a green light. 1 red box and you walk away. Number 3, your 3 numbers written down first. Before a single cent is at risk, you decide your entry, your stop loss, and your target in advance while you are calm, never in the heat of the trade. These 3 numbers are your whole plan on one line. Number 4, your position size. You risk only about 1% of your account on any single trade. The distance to your stop decides how many shares you buy, not how confident you feel. This one rule is what keeps a bad trade from becoming a disaster. And number 5, your journal and your weekly review. You log every trade, and once a week you read them back, repeating what wins and cutting what loses. This is the only part of trading that truly compounds. So there it is, 5 components. Now let us meet the 3 traders who are about to put them to the test. Now let us actually build and run a plan on one real trade step by step so you can copy it. This is Apple, and it is in a clean uptrend, higher highs and higher lows. Our one setup is a pullback to rising support, and right here price pulls back to support near 295. That is our signal to get ready. Before we even think about buying, we run the checklist. Is the trend up? Yes. Is price at our support level? Yes. And is the reward at least double the risk? Yes. 3 green checks, so this trade is allowed. Now we write our 3 numbers in advance while we are calm. Our entry is 298 on the bounce off support. Our stop is 294, just below support, so our risk is only $4 a share. And our target is 306, exactly 2 times that risk. Then we size it. Risking just 1% of the account with that $4 stop tells us exactly how many shares to buy. The math sets the size, not our excitement. Now we simply execute the plan as written. We buy the bounce at 298, and then we do nothing but wait. We do not touch the stop, we do not panic, and a couple of days later, price tags 306, our exact target. We are out with a clean 2R winner. Last step, the part most people skip: we journal it. Clean pullback, followed the plan to the letter, plus 2R. That, start to finish, is what running a one-page plan looks like. Now let us prove what it is worth. You just watched the plan work on one clean trade, but one good trade proves nothing. Anyone can get one right. So now we prove what this plan is really worth over a whole year and many trades by following 3 traders who each follow more or less of those exact same 5 rules. They each start today with exactly $10,000. They will trade the very same market and see the very same charts, and the only difference between them is how many of the 5 rules they actually follow. First, our hero, Derek, the pro. Derek follows all 5 rules on every single trade. He plans his setup, runs his checklist, writes his 3 numbers, sizes at 1%, and journals everything. 5 out of 5. Next, the common man, Sam the amateur. Sam is not reckless. He has a plan and a rough checklist, but he never journals, never reviews, and he sizes his trades by gut feeling. 2 out of 5. And the villain, Ricky the gambler. No plan, no checklist, no stop loss. He chases tips, bets big, and doubles down when he loses. 0 out of 5. Now let us follow all 3 into 3 real trades and watch their accounts pull apart. Our first trade is a tempting trap, and here is the actual chart. This is NFLX, and it has been falling for weeks. Look at the highs I am marking. Each rally tops out lower than the last, lower high than a lower high. That staircase down is the textbook signature of a downtrend, sellers in control. But then price drifts down to 85, a level that bounced before, and it lights up like easy money. All 3 traders are looking at this exact spot. Now watch what each one actually does and why. Derek, the pro, runs his checklist first. Box 1 is the trend up. No, it is clearly down. That is an instant red light, and Derek's rule is simple. He only buys uptrends, so he skips it completely. Look at his card: no entry, 0 risk, account untouched. The checklist just saved him from a trade he was never supposed to take. Sam, the amateur, has no hard rule about the trend, so the tempting bounce talks him into it. On May 29th, he buys a small position right here around 86 on a hunch with only a loose mental stop. The very next trading day, June 2nd, The bounce fails and Netflix breaks down hard through 85. Sam bails around 84.5 for a $300 loss, and notice he got out immediately the moment it went against him. Small loss only because his size was small, and Ricky, the gambler, sees easy money and goes all in at 86. No checklist, no stop, pure fear of missing out. When 85 cracks, he refuses to sell, telling himself it has to bounce. It does not. It keeps bleeding, and 2 days later, on June 3rd, near 81, he finally cracks and panic dumps the entire position for a brutal $2,600 loss. Same chart, same bounce. Derek risked nothing. Sam lost a little and fast. Ricky lost a fortune by freezing. All three outcomes were decided before they ever clicked buy. Now watch the scoreboard after just one trade. Derek, who skipped, is flat at the top. Sam is down a little, and Ricky is already down $2,600, all from a trade Derek never even took. The gap is open. Trade 2, and finally, a real opportunity. This is the actual Airbnb chart, and it is a clean uptrend, higher highs and higher lows. Price pulls back to its rising support line right here at the swing low near 128. This time, the chart matches Derek's plan perfectly. Derek runs his checklist and every box turns green. Trend up, price at his level, reward double his risk. So he writes his 3 numbers in advance, exactly as planned. Entry at 131, the teal line. Stop at 127.50, the red line, just below support. And target at 138, the green line, a clean 2-to-1. Then he sizes it, 1% of his account, risking about $350 and no more. He buys the bounce off support right at his line. And watch it work. Price climbs, and a few days later it tags 138, his exact target. Derek banks a clean 2R winner plus $650. Calm, sized, repeatable. Now Sam, and this is the amateur's most expensive habit. Sam buys the exact same trade, in at 131 right next to Derek, but Sam never wrote down a target. So the moment the trade goes green and price ticks up to around 134, fear takes over. He is terrified the little profit will evaporate, so just 1 day later he grabs a tiny $180 and runs, selling way down here while the move is just getting started. That is the classic amateur mistake. Sam cut his winner short out of pure fear and left about $470 on the table. Amateurs cut their winners early and let their losers run. The pro does the exact opposite, and you just watched it. Derek held to his target. Sam panicked into a tiny gain, and Ricky is not even on this chart. He is off chasing a hot tip on something else entirely, and this time he gets lucky and bags $1,700. His account jumps, and so does his ego. Remember that feeling, because luck always sends a bill, and Ricky's is about to come due on the very next trade. After trade 2, everyone is green for once, but look closer. Derek's $650 came from a plan he can repeat 1,000 times. Ricky's $1,700 came from luck he cannot. One of these builds an account. The other builds a gambler who is about to bet the farm. Trade 3 is the one that defines a trader, the gut punch. Here is the real Amazon chart. Price has formed a textbook double bottom, a floor at 255 that held twice here and here. It looks rock solid, it looks safe. So, this time, all 3 traders buy it, all 3 enter together at 257. And then, without warning, the floor cracks and price breaks down hard. This is where the plan earns everything. Watch Derek first. The moment he entered, he set a hard stop just below the floor at 253, risking only 1%. When the break comes, his stop fires automatically. He is out for a small controlled loss of $300, and then he does the most important thing of all. He opens his journal, writes good loss, support failed, and walks away completely calm. Sam sized at 5%, far too big. With a loose stop he kept sliding lower and lower, just hoping. By the time he finally panics out on June 3rd down near 250, he is down $1,500, 5 times Derek's loss on the exact same trade. Fear got him out of the winner too early last time, and kept him in the loser too long this time. And now Ricky, the gambler, and this is the crux of the entire video, so watch exactly how an account dies. Ricky went 30% all in at 257, no stop, because in his head stops are for cowards. When the floor cracks on June 2nd, a disciplined trader just takes the small loss. Ricky cannot accept being wrong, so he tells himself the story every blown-up trader tells: if I buy more down here, I lower my average price, and then it only needs a tiny bounce to get me back to even. So right here at 254 he adds more, doubling down on a position that is already bleeding. But the market does not care about his average price. The next day it keeps falling, his loss is now twice as big and his hope is twice as loud, so near 250 he averages down a second time, throwing the very last of his cash at a falling knife, and right here at 247 it ends, and not by his choice. The broker issues a margin call and force liquidates the whole position. Account at zero. So sit with this for 1 second, because it is the entire lesson. It was the same trade for all three of them. Derek lost $300 and was calm enough to journal it. Sam lost $1,500 by hoping. Ricky lost absolutely everything, not because his chart was different, but because he could not take one small loss on purpose. So the market took one enormous loss for him. A stop loss, a 1% position size, and the humility to be wrong. That is the whole difference between a bad afternoon and a blown-up account. And there it is. The same Amazon trade cost Derek a forgettable $300, and it cost Ricky everything. His red line falls off a cliff to zero and never comes back. That is what averaging down with no stop does. Sam survives, but he is bleeding, and he still has no idea why. Now jump to Saturday morning, the part of trading nobody films. While the market is closed, here is what each of our three traders is actually doing, and it matters more than any single trade. Derek, the pro, sits down with a cup of coffee and opens his journal. Trade by trade, he tallies what worked and what did not. His pullback setups and uptrends like Airbnb keep winning. His counter-trend trades, the tempting ones like Netflix, keep losing. So he makes one small change. He stops taking the losers and does more of the winners. That quiet hour is his edge, and over the next month it compounds his account past $12,000. Sam, the amateur, is on the couch scrolling his phone. He never journaled a single trade, so he genuinely has no idea which of his trades make money and which bleed it. He will walk into Monday and make the very same mistakes, and his account just treads water, going nowhere. And Ricky, the gambler, is staring at an account that says zero. There is nothing left to review. He rage quits, deletes the app, and blames the market, the brokers, and everyone on earth except the one person who actually blew up the account. The journal is the only part of trading that compounds, and only one of them ever opened it. And watch what that quiet Saturday hour does over the next month. Derek's reviewed edge compounds, and his line pulls away to over $12,000. Sam, who never reviewed, just trades water. The journal did not feel exciting, it just quietly won the whole game. So let us jump forward one full year. Same market, same starting money. Here is exactly where all three of them end up. Derek, the pro who followed all 5 rules even when they were boring, turned his $10,000 into over $14,000, up 42%. Sam, the amateur who had a plan but never journaled and sized by feel, finished slightly down at $9,300, a whole year of effort, and he went backwards. And Ricky, the gambler who followed none of it, is at zero, wiped out, just like the 90% of traders who jump in with no plan. Look at all 3 curves at once, because this single picture is the entire video. They did not have different markets, they did not have different luck, not over a whole year. They started with the same money and saw the same charts. The only thing that separated the winner from the broke was a written plan, a risk rule, an honest journal, and a weekly review. That is the whole game, and now you have watched it happen. Here is the truth. This case study just proved you do not have to be a genius to win at trading. You just have to be Derek. You need a written plan and the discipline to run it on every single trade, especially the boring ones. So tonight, do one thing. Write your one-page plan, your one setup, your checklist, your 3 numbers, your 1% size, and a blank journal. Then on your very next trade, follow it to the letter, win or lose, and never, ever average down into a loser with no stop, because you just watched exactly where that road ends. A year from now, you get to choose which of these 3 traders you become. The market does not decide that, you do. If this case study finally made the plan click, subscribe, because we build one new trading skill from the ground up every single week. See you in the next one.